Thanks for inviting me to participate. It's true what you asked me. The global spread of COVID-19 is affecting all industries and all directions. Measures already taken, such as travel restrictions and population lockdowns, are creating a dramatic fall in economic activity. In any way, what I do expect is that investment transactions will reduce over the course of the year. The access to capital remains a priority, and market conditions are particularly challenging. Engagement and communication with financial counterparties and investors is critical. However, what I must say is that investors are likely to wait and see how the markets develop in the coming months. Institutional investors will focus more than ever in the next years on the real estate sector, as I believe it will be seen as a safe value or safe asset. Coming back to the issue of which are the sectors most impacted, what I think is that hospitality and tourism have seen the most significant impact from COVID-19, with an almost complete shutdown in activity and bookings in many countries. However, there are already signs of recovery, which are beginning to emerge in China. To conclude, I think that hotels and retail will see the biggest impact in their businesses, whereas the industrial and logistics business will show greater resilience to this crisis. As for the impact of increasing liquidity in the economy, as you asked me, I think it's quite clear that several central banks, including the US Federal Reserve and European Central Bank, have already initiated a whatever-it-takes approach to monetary policy. In Europe, let me give you this fact, the European Central Bank, the ECB, has responded by announcing 700 billion of euros in an acquisition program for government bonds, in addition to its 120 billion asset purchase program, both of them to stimulate domestic demand. The scope of the credit programs has expanded to make available to companies, including small and medium-sized businesses. While these measures alone, by themselves, cannot immunize 100% real estate by itself, they can help in any way to limit the damage. I think that this is good news. The question you raised, the actions of the governments are being the right ones? I think that basically yes. The response from the policymakers throughout the world, and I refer both to governments and central banks, has been substantial, and I think that's a positive response, but probably it's not sufficient. And given that the response for the time being has been essentially a matter of monetary policy, now is the moment for a move. It's the moment for a fiscal policy response. In this context, in the European Union, Minister of Finances of the Member States accepted that the conditions for the use of the General Escape Clause of the European Union fiscal framework are fulfilled. And this is positive because this will allow to provide flexibility to take all necessary measures for supporting the health and the civil protection systems, but also to protect our economies, including through further discretionary stimulus and even further state aid and tools, instruments. Governments have also used strong fiscal policy stimulus to help lessen the impact of the crisis. Initially, many fiscal measures aimed to bolster the healthcare system, but it's true that many governments did not stop there, and they realized that such actions would likely prove inadequate and require more government spending or tax cuts. Some measures have targeted consumers, while others have been directed to companies which are which are exposed to this crisis. So doing in this way, that will help to prevent or lessen job losses, and this will be crucial for all the economy, in particular for the real estate sector, and much in particular for the tourism. These measures, I think, are unlikely to be the final response, and I still expect governments to expand additional funding once the extent of the downturn becomes clear. Secondly, you asked me about specific measures for the real estate sector. In this matter, I would say, let's focus on the first part of the question. I already answered you. I mean, let's focus on the fiscal policy responses for sectors specifically damaged for the crisis. What I have in mind is the tourism sector and the hospitality sector. And let's be prudent, or let's be careful with other regulations. One relevant factor that will become evident after the crisis is the risk, I would say, of public intervention on the regulation, which entails the relationships between private businesses or in the field of the private investments. Countries around the world have implemented changes to real estate policy in order to reduce the burden on tenants, and in some cases there are some regulation for the landlords. In my view, if those changes in regulation may have a need, or may have a sense in right now, what is positive to understand is that those changes should be temporary, should be limited to a number of months, but very limited. After the emergency in the health system is solved, the regulation should go back to the current situation prior to the health crisis. Yes, Antonio, you are right. Portugal and Spain, both of the countries are more than 90% dependent on the air transport. And now the biggest concern until the end of the year will be how we can reassume those level of tourism. I must say I'm not optimistic at all. It's not going to be easy because it seems quite clear to me that there is a lack of confidence among the tourism services consumers. For this reason, the hotel sector has been one of the first commercial property sectors to be affected by the COVID-19, given that the European airlines have cancelled thousands of flights and governments unveiled repatriation agreements with airlines to return home their tourists. So, for this reason, investment in hotel assets will continue to be a safe investment in the long term, although it will damage in the short term by its vulnerability to health crisis.